Welcome to the Deep Dive. Today we're tackling a really interesting economic puzzle.
Yeah.
What's going on with interest rate spreads in countries that use the US dollar?
Huh.
Specifically, we're looking at Ecuador and El Salvador.
Right.
You're here because you want to get up to speed on complex stuff, quickly but properly.
Yeah.
So think of this as your shortcut.
Absolutely. And the starting point, the initial idea when a country like Ecuador or El Salvador dollarizes Ecuador did, El Salvador in 2001 is, well, you get rid of currency risk, right?
hmm
The risk that your own money loses value. So interest rates should come down. Seems logical.
It really does. And to be fair, we have seen rates fall, both deposit and lending rates in both countries since they switched.
Sure.
But here's the kicker. The gap between those rates, the interest rate spread,
Right.
it stayed way higher than in the U.S.
Yeah, significantly higher. Just for context, there was a study, Philippon, back in 2015, showing the U.S. spread averaged around, 2% for like 130 years?
Wow, okay, so 2% in the U.S.
Yeah.
and in Ecuador and El Salvador.
Much bigger gaps. Much bigger. And they're not even the same between the two. Ecuador's spreads are consistently about 2 percentage points higher than El Salvador's,
Even with similar deposit rates.
even with similar deposit rates. So that's the core puzzle, isn't it? Why the difference, even with the dollar?
Exactly. So our mission today is basically to figure out why are these spreads so high and why are they different? Because, high lending rates can really put the brakes on investment, on growth.
Which are often the main reasons countries dollarize to begin with.
Right.
And we have to remember the context here. These dollarized economies, they don't have what economists call a lender of last resort.
Oh, the LOLR. No central bank safety net.
Precisely. And people like Green pointed this out years ago, that absence can really change how banks think about liquidity, about how much capital they need, how much risk they take. All that stuff feeds into spreads.
Okay, so let's unpack this. We're basing this on some solid data, right?
Yeah, we've got panel data, covers 33 banks in Ecuador, 24 in El Salvador, running from 2005 right up to 2019.
In panel data, just quickly, that means we're following the same banks over time, not just snapshots.
Exactly. It lets us see how individual banks change, how their characteristics, their profitability, link to the rates they charge. It's much richer.
Got it.
And what this data really shows is, yeah, they both use the dollar, similar development stage, institutions kind of similar, but the drivers of these spreads, quite different.
Okay, so let's start digging into those drivers, maybe bank-specific things first.
Sounds good. Let's kick off with liquidity, how much cash banks have readily available.
Right.
In Ecuador, banks with more liquidity, higher liquidity ratios, they actually charge higher spreads.
Wait, higher liquidity means higher spreads. That sounds backwards.
It does seem counterintuitive, yeah. But think back to that missing lender of last resort.
Okay.
Ecuador brought in stricter liquidity rules back in '09 because they didn't have that safety net. These rules, they basically force banks to hold a lot of liquid assets inside Ecuador. But Ecuador's domestic market isn't, super deep. So banks often end up holding things like government debt, lower return, maybe riskier sometimes just to meet the rules.
Ah, I see. So they hold these less exciting assets.
And it looks like they try to make up for it by widening the spread on their loans. So a regulation meant to ensure safety might actually be pushing up borrowing costs.
An unintended consequence. That's fascinating. So that's Ecuador. What about El Salvador? Does liquidity matter there?
Well, interestingly, no. Not significantly, anyway. They don't have those same really strict domestic liquidity requirements.
But the average liquidity levels are similar.
Yeah, roughly similar on average, according to the data, but the impact of holding that liquidity, totally different.
Okay, let's move to capitalization. Banks own money, equity. In Ecuador, more capital means,
Higher spreads again.
again, why would being financially stronger lead to higher borrowing costs?
Well, one theory, and we see this elsewhere too, is that a really well-capitalized bank is seen as safer, more stable,
Makes
so maybe they can borrow funds more cheaply themselves. But instead of passing those savings on,
they pocket the difference, increase the margin.
that's the potential explanation, yeah. They leverage their perceived soundness.
So in Ecuador, strength equals pricing power, maybe? But El Salvador is the opposite, right? More capital, lower spreads.
Exactly the opposite. In El Salvador, it's possible that a higher equity ratio is sort of a proxy for risk aversion.
How so?
Well, a bank with a bigger cushion might just be more cautious. Maybe they prefer safer, lower return loans and investments. Perhaps that missing lender of last resort makes them extra cautious.
Could be.
And focusing on safer stuff naturally means narrower spreads.
Wow, quite the contrast. Okay, what about just the basic costs of running the bank? Operating costs.
In Ecuador, it's pretty straightforward. Higher operating costs seem to get passed on to customers via higher spreads.
That tracks. And El Salvador.
The effect isn't statistically significant in this analysis. And it's worth noting, their average operating cost ratios are actually lower than in Ecuador anyway.
Okay. And income from things other than interest. Fees, commissions, non-interest income.
Yeah, in both countries, if banks earn more from those other activities, they tend to have lower spreads. Suggests they're less reliant on just the lending margin.
Makes sense.
But the effect is actually bigger in El Salvador.
Interesting. Okay, one last bank-specific thing. Credit risk.
Yeah.
Measured by loan loss provisions. Money set aside for bad loans.
Right. And probably no surprise here, in both countries, banks setting aside more for potential losses tend to charge higher spreads.
Compensating for the risk.
Exactly. Though, interestingly, this effect seems a bit more pronounced in El Salvador.
Okay, so that's a good look inside the banks themselves. Let's zoom out a bit. Think about the market structure, market power, for instance. Does a bank's size, its market share, matter?
It does. Generally, in both countries, as a bank gets a bigger slice of the pie, its spread tends to go down.
Suggesting economies of scale.
Yeah, maybe bigger banks are just more efficient, lower costs per transaction, that kind of thing.
Like you said, buying in bulk, better tech.
Exactly. So those efficiencies might let them operate with thinner margins. However,
Uh-oh, here it comes.
here's where it gets really interesting. If you look specifically at the market share of the really big banks, the study defined this as banks holding at least 9% of total system assets.
Okay, the dominant players.
Right. When their market share increases, spreads actually go up in both countries.
Whoa. So bigger isn't always better for borrowers.
Not when it's concentrated at the very top, it seems. And this effect, the spread increasing with large bank market share, is stronger in Ecuador.
So let me get this straight. Overall market share increase, spreads down. But increase in large bank share, spreads up.
Pretty much. If you calculate the net effect for a large bank increasing its share by 1 point, the spread goes up in Ecuador, but actually still goes down slightly overall at El Salvador.
That's a critical difference. It really suggests the biggest banks in Ecuador might be flexing their market power more, maybe?
That's certainly how it looks, yes. A very plausible reading of the data.
Okay, what about another structural factor? Foreign banks. How do they fit in?
In Ecuador, the finding is that when foreign banks gain market share, spreads tend to fall.
Which sounds like good news for competition and borrowers.
It does. And remember, foreign bank presence in Ecuador is actually quite low right now.
Especially compared to El Salvador, you said,
Yeah.
where they dominate.
Exactly. El Salvador's banking system is largely foreign-owned, so this finding hints that maybe Ecuador could benefit from encouraging more foreign banks to enter.
Okay, but what happens in El Salvador, where they already have lots of foreign banks?
That's the twist. In El Salvador, an increase in foreign bank market share is associated with higher spreads.
Higher. The opposite of Ecuador. How does that work?
It seems contradictory, right? But again, we need to dig a bit deeper. It's not just whether a bank is foreign, but where it's from.
The origin story.
Precisely. In Ecuador, the foreign banks driving that negative link with spreads, the ones associated with lower spreads, they're mainly from developed economies, what the study calls first-tier countries. That's mostly who's there now.
Okay.
But in El Salvador, the foreign banks linked to higher spreads are primarily not from those first-tier countries. They're often from other countries in the region, for instance.
So banks from developed countries might compete differently or have different strategies than banks from, say, other developing countries.
That's what this suggests, and it lines up with some other research out there, too. The home country matters.
That's a really crucial nuance.
Sure.
Okay, quickly then, what about broader macroeconomic factors, like the overall economy?
Right. So when bank deposits are growing faster than the whole economy, the deposits to GDP ratio as rising spreads tend to fall in both countries.
Meaning banks have easier funding, so maybe they compete more on price.
Plausibly, yeah. And this effect is actually larger in Ecuador, which is interesting because Ecuador's overall deposits GDP ratio is much lower than El Salvador's.
And country risk. Like how risky investors think the country is.
They looked at the EMBI spread for that. Increases in perceived country risk are linked with higher bank spreads in Ecuador, but honestly, the statistical link isn't super strong there.
Okay. And last category. Regulations, taxes, reserve requirements.
Taxes don't seem to move the needle much on spreads in Ecuador, and the effect's pretty small in El Salvador, too.
And reserve requirements. The money banks can't lend out.
Not a big factor in Ecuador, according to this, but in El Salvador, higher reserve requirements are actually linked to lower spreads.
Lower. That's another slightly counterintuitive
It
one.
is a bit puzzling, yeah. Needs more thought, perhaps.
Okay, wow. We've covered a lot of ground. Let's try to pull this all together. What are the
Sure.
big takeaways here?
I think the headline is dollarization isn't a magic bullet for low spreads, and it definitely doesn't make banking systems identical.
Right.
Ecuador and El Salvador, despite both using the dollar, have really different things driving their interest rate spreads. Bank level stuff like liquidity management, especially with Ecuador's specific rules and capitalization, matter differently.
Then the market structure stuff, too.
Absolutely. How concentrated the market is among the biggest players, and crucially, the presence and the origin of foreign banks seem to have very different effects in the two countries.
So going back to that initial puzzle,
Yeah.
why are spreads high and why higher in Ecuador? It's clearly not just about the currency.
Not at all. It's a mix of regulatory choices like those liquidity rules in Ecuador, market power dynamics, how big banks behave, and the specific nature of competition, especially from foreign players.
And understanding this isn't just academic, is it? It matters for actual policy.
Definitely. If you're a policymaker in a dollarized country or thinking about dollarizing, you need to grasp these nuances. You can't just assume adopting the dollar fixes everything. You need policies that foster competition and efficiency in the banking sector itself. That's key for growth.
Okay, so maybe a final thought to leave our listeners with. Given everything we've discussed, especially those surprising differences in how foreign banks operate depending on where they come from, what other, maybe more subtle factors could be shaping these interest rate spreads in dollarized countries?
That's a great question.
And how can policymakers use these kinds of insights, so ones we've dug into today, to really build banking sectors that are more competitive, more efficient, and ultimately better at supporting sustainable growth?
Yeah, plenty to think about there. How do you fine-tune the system beyond just the currency choice?
Exactly. Definitely something to mull over. Thanks for joining us for this deep dive.